Frontline stocks push higher even as broader markets are evenly balanced on advance and declines. Positive net foreign flows help buoy the sentiment even as tariff uncertainties loom. Trump announces the imposition of 25% tariff on all car, LCV and auto part imports into the US from April 2nd, spooking auto stocks. Tata Motors is a key loser on fears of tariffs, denting JLR sales. Wipro bags a hefty $650 million 10-year digital transformation deal from Phoenix Group UK. The stock perks up on the win. In a significant milestone for Maruti Suzuki, Sunil Kakkar becomes the first executive to be appointed to the company's board. Meanwhile, HUL ropes in Britannia's Rajneet Kohli to lead its food business. CLSA strategist Lawrence Vilanco believes that the market has bottomed out and expects Nifty to scale to 26,000, but Goldman Sachs' Sunil Kaul advises caution on tariff uncertainties and the domestic slowdown. Hello, good afternoon. You've tuned into Business Lunch coming live from CNBC-TV18 Motilal Oswal Studios. I'm Winnie Motiwala and thank you so much for tuning into CNBC-TV18. Markets have recovered from the day's lowest point, right? We're seeing green coming in for the Nifty, Sensex, Bank Nifty also holding on to good gains as well. And Nifty did open up in the red, right? Look at it on the chart. The markets had opened up in the red, then at the day's highest point. As of now, 23,600 is what the Nifty is holding on to. Nifty Bank also similar charts that pattern that we're seeing coming in for the Nifty Bank as well. Right now, trading at the day's highest point is what the Nifty Bank is doing, up 0.8% in today's trading session. The mid and small cap, we're seeing green on the screen, but it's not outperforming the benchmark indices. So mid and small cap managing to hold on to green, bit of an underperformance on that front. Look at the sector that is doing well other than banks is energy. That's managing to hold on to gains of 0.8%, as well as FMCG, some bit of a gain today coming in on that front as well. Other than that, pharmas, autos are not doing well, trading in the red. Both are down almost 1% in today's trading session as of now. Advanced decline ratio, like we mentioned in the headlines as well, that it's, just in the middle. There's not much of an advance, not much of a decline. It's somewhat at the similar levels. Advance is at 1,231 stocks, while a decline is at 1,402 stocks. But yes, that's what the market setup is looking like. But let's talk about an important sector that is in focus today, that is the auto. And specifically in auto sector, we have Tata Motors that is in focus. And why is that so? And other than that, Samvardhana Motherson also. Let's put the spotlight on both these stocks right now. What is the reason? We're seeing that US has imposed a 25% tariff on imported autos. Sudarshan is joining in with us to give us more details on this front. Sudarshan, both these stocks see the most amount of impact?
That's correct. So first about the news, US government, basically US President Donald Trump has announced that he'll impose 25% tariffs on all the cars that are not made in India. Also, reports suggest that tariffs will also be imposed on auto parts, and these tariffs will be effective of April 2. Now, why Tata Motors will be impacted? Because if you remember, JLR has one of the important markets, that's the US, and US currently forms 1/3 of its total sales. The important point is JLR does not have the production facility in the US, and all the cars being sold by JLR in the US are imported from countries like UK and China. The second company that is going to be impacted most is Samvardhana Motherson. Why? Because Samvardhana Motherson's total revenue comes around 40% comes from the US. But the important part is it supplies parts to those automakers which export their cars to the US. So indirectly, there might be an impact of Samvardhana Motherson in the range of 6 to 7%. And that's the reason you are seeing a big fall in both the names.
Okay, Sudarshan, thank you so much for the update there. But in fact, let's listen into the President of the United States, Donald Trump, on what he said on auto tariffs.
We're going to charge countries for doing business in our country and taking our jobs, taking our wealth, taking a lot of things that they've been taking over the years. They've taken so much out of our country, friend and foe, and frankly, friend has been oftentimes much worse than foe. And this is very modest. And what we're going to be doing is a 25% tariff on all cars that are not made in the United States. If they're made in the United States, there's absolutely no tariff. We start off with a 2.5% base, which is what we were at, and we go to 25%.
And a short while ago, President Donald Trump also announced that larger tariffs could be placed on European Union and Canada. The president, in his post on Truth Social, wrote that if EU and Canada do economic harm to USA, large-scale tariffs will be placed on both of them. Now, staying with this news, CNBC's Eamon Javers has a report on what he's learned from the White House on the upcoming April tariffs.
Speaking to Newsmax yesterday, said in terms of the April 2nd tariffs next week, he's inclined to be more lenient than reciprocal, because if he is too reciprocal, then that could be too tough on people. So I talked to a White House official this morning to figure out what exactly that means, more lenient than reciprocal. And what I'm told here at the White House today, Carl, is that what the president is signaling here is that he is not going to take into account all the non-tariff barriers that countries raise against the United States. Remember, early on in this debate, the White House said that they would include things like a VAT tax, wage suppression, currency manipulation, those kinds of things in their calculation of a tariff attack on the United States, and therefore that would be part of the reciprocal tariff back. Now what I'm told is that they're signaling they may not go all the way to including all of those non-tariff barriers in determining what the reciprocal tariff rate should be country by country. How are they going to decide that? I'm told it's more or less going to be on a case-by-case basis, but what they're signaling is that a lot of the stuff they said they would calculate against, they may not actually calculate against. So it is a sort of lessening of the severity of the potential tariffs that we're talking about based on what they had said before. Now, there were a lot of critics who said, as our Megan Costello points out, that some of these non-tariff barriers should never have been included in a discussion of tariffs. Nonetheless, the White House signaling today they might not go all the way in including some of those non-tariff barriers next week.
Now, even as Trump's tariff threat looms, sources told CNBC-TV18 that the ongoing bilateral trade agreement talks between India and the US are going well. The Indian industry had expressed concerns about the impact of these tariffs on companies and job operations and seeks an early bilateral trade agreement with the country. Their aim is mainly to avert or delay the tariffs that will begin next week. Now, sources add that the industry has written to the government to protect them from the impact of reciprocal tariffs. Sources tell CNBC-TV18 that Prime Minister's office, the Commerce Ministry and the MEA officials are in active discussions to consider tariff cuts for the United States. Tim C is joining with us to give us more details on this one.
Well, yes, as you rightly mentioned, what we are picking up from sources is that the top officials from the Prime Minister's office, MEA and the Commerce Ministry are in active discussions to consider tariff cuts that can be extended towards US. To be precise, no list has been finalized as yet because it is the entire goods list, that is the commodity side that we import from US, is all on the drawing board along with what are the current rates. And exactly based on that, government is looking at various permutations and combinations as to what can be offered to the US. As we speak, the comprehensive review of the current import categories and duties is currently being undertaken, and the discussions are still on. But sources indicate that even as there is no final decision that has been taken, but some of the commodities, some of the goods that could see a tariff cut could include medical and scientific instruments, where the current basic custom duty is at 7.5% to 10%, cruise and ships, where the current rate of basic custom duty is 10%, aircrafts, where the current basic custom duty is 2.5%, spacecrafts, where the current basic custom duty is 10%, cars, where the basic custom duty ranges between 70% to 100%. Also, when it comes to the next categories, turbojets and propellers, where the current basic custom duty is 7.5%, high-end jewelry, where the basic custom duty is 20%, gems and jewelry also is on the list, where there could be a cut, where again the basic custom duty is 20%. Footwear, where the duty is at 35%. Plastic polymers, where current basic custom duty is between 7.5% to 15%.
Right.
Organic chemicals, again, where the basic custom duty is about 7.5%. Just to put things in perspective, India in the last calendar year, that is 2024, imported about 35 billion worth of goods from US, which was a 6.5% of growth when compared to the calendar year 2023. So let's see what happens finally. What is the decision that has been taken by the top Indian government? Back to you.
Absolutely. Thank you so much for that, Tim C. But let's also listen into what Goldman Sachs' Sunil Kaul has to say on reciprocal tariffs and its impact on the Indian market.
Our sense is that it could still be an initial shock, as I said, because the numbers will be higher than what the market is currently anticipating. And then there is a room for negotiation. There's a window for each country, in which case I think there will still be sort of uncertainty in the market. Agri has the largest sort of tariff differential if you do sort of US versus India. I mean, so that could be impacted. But we think, for example, like pharma could be an area that could be impacted as well. Autos. I mean, in addition to the reciprocal tariffs, we also think that overall in the tax measures, you could see a global sort of auto tariffs. You could see tariffs on critical imports. And when we think about critical imports, electronics and components is one of the things the Trump administration has talked about. I think if you just looked at the rate purely on the basis of product by product weighted average reciprocal tariffs, which is that if US matches sort of India's tariffs on each of the products, that effectively is about 11 percentage points of higher tariffs on India. But then I think we also have to keep in mind that the number could be a bit higher because of non-tariff measures like subsidies and import bans, and there are also kind of VAT. And so there is a lot of uncertainty whether the US does include VAT, does not include VAT. Europe is obviously a large risk there as well. So depending on what the number could be, it could be north of sort of pure 11 percentage points, which is based on the weighted average tariff rates.
Okay, on that note, we're going to step into a very short break, but here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screen. Welcome back to Business Lunch on CNBC-TV18. Now let's move on. Days after the Atlantic revealed that the Trump administration discussed plans to attack Houthi, a target on the Signal app group. The publication has released additional chats that took place on the group as well. And apart from that, the revelation have caused massive furor in the Washington DC, with both the Democrats also in focus as well as the Republican as well. But let's move on and talk about Wipro, because Wipro is in focus as well and is among the top Nifty gainers after the company announces $650 million deal, a UK insurance company, and this is the deal what is there. Rima is joining with us to give us more details on this one.
Thanks so much for that. So indeed, Wipro's won a mega deal, £500 million, which is about $650 million US spread over 10 years. So incrementally, it could add close to about 0.5, 0.6% to Wipro's top line. And remember, the company that they won the order from, UK's Phoenix Group, already has a long-standing relationship with TCS. Actually, that's what makes Kotak very bullish. So they're saying this deal is notable because it marks Wipro's entry into an account which has been a strong hold for TCS. Also, this is the second mega deal that Wipro has won in the last 4 quarters. According to Kotak Institutional Equities, the deal will ramp up from December of 2025 quarter, that's Q3 FY26, and fully ramp up by the end of FY26. Initial profitability of the deal will be low, as is the case typically with mega deals. But according to Kotak Institutional Equity, Wipro will be able to make up for the margins and hold on to margins of about 17.5% through the duration of the entire deal. That said, even though Kotak is enthused by this mega deal win, win by Wipro. They still have a sell rating on the stock with a target price of 265. They're cautious because, you know, a turnaround requires many things to go right at the same time. It is challenging, and while Wipro's growth, underperformance versus peers will continue to narrow, it will still underperform its peers. Morgan Stanley too, acknowledges that this deal should support expectations of a pickup in revenue growth for Wipro in FY26, especially in a volatile macro environment. They too have an underweight call on the stock, and their target price too is 265.
Okay, and a quick look at the market as well. We're seeing the green across the screen, but one stock that is falling in trade is Capri Global. We've seen a sharp fall coming in for the stock in just the last half an hour, so keep an eye out on Capri Global. But my colleague Prashant is in conversation with Joe Taylor, the CEO at Ontario Teachers Pension Plan. Let's go across and listen into their conversation.
Ontario Teachers Pension Plan is one of the world's largest and most influential institutional investors, managing nearly $200 billion in assets globally. Their investments in India stand at over $4 billion and are growing, with a diversified portfolio that spans infrastructure, private equity, real estate and tech. Ontario Teachers is known for its long-term patient capital and disciplined investment approach. Today, I have the pleasure of sitting down with Ontario Teachers' CEO, Joe Taylor. Joe, welcome to the program. Thank you very much.
Thank you for having me.
For markets globally, it has been a time of change, some confusion, but lots of opportunities ahead as well. So with that short preamble, let me dive straight in. Joe, once again, how are you liking your Mumbai trip so far?
It's always nice to come here. I find the optimism in India really encouraging, and there's good reason to be optimistic. Lots of good things happening in the country.
Although right now, a lot of the focus is on what's coming next week, 2nd April. Trump tariffs, reciprocal tariffs day, or as President Trump has been calling it, Liberation Day for the U.S. I mean, as a patient, long-term investor, Joe, how are you thinking about this? Do you think, do you go with the this too shall pass attitude, or you think it'll do some durable damage?
We're probably a bit in the middle. So we are a very long-term investor. You know, our liabilities go out 40, 50 years. So the first thing you want to do is not overcompensate. And some of the impacts of the tariffs isn't really fully understood yet. Second thing to say is we try to plan to have a very diversified portfolio, both in terms of the asset classes we hold and actually where we hold it around the world. So really what we're trying to do always is to be agile, but also to be thoughtful about what we might want to bring in as new investment activity and where we probably feel a little bit more exposed. But coming back to the US, we probably have around 30 billion of investment there. So it's a material market for us, and it's also been a very profitable market for us over 20, 30 years.
You said I don't want to overcompensate, but is there a risk of underpricing the risk?
Well, our job's not to do that. We do take risk and we're willing to do it. We're a mature plan, so we have to be careful. Our contributions out exceed our payments in every year. But what I think I would say is that you can overreact sometimes to news flow and things that look like they could be a material impact on your activities without really fully thinking through how it's going to land. I think we're honestly still in that mode of still trying to evaluate what to do. But certainly, if you're based in Canada at the moment, there's a lot of reflection. We've got an election coming up. We've also got quite a few initiatives that have been developed about how we continue to invest in Canada ourselves, but also how do we help trade where it may be going less into the US than it did before. You sit on top of one of the largest sort of institutional investing assets globally. My question is, which way are you leaning? Do you think this will be a bit of a break from the past, what is being proposed, America first, tariffs, and it looks like they really believe in it. It's not like a negotiating tool and then you sort of propose something and walk back all of it. We will find out. But without going into specifics, do you think it's on many fronts, not just from a market standpoint, it's a bit of a break from what we've had so far for a few decades, actually? It does feel something different. We're actually trying to plan for something that is enduring, because that's the easiest way to be sure of probably the one with the biggest implications for an investor like ourselves. The thing I would stress is, and you did it in your introduction, so thank you for doing it, is, we are an international investor.
Yeah.
We do look to try and have a diversified portfolio around the world. That's why I'm here in India. That's why we have a team on the ground here. And sort of my job is really to say if it gets a little bit more tricky in some markets or some asset categories, what do we do? And that agility and that willingness to innovate and try some other things out has really stood teachers out for a little while.
The other, so for example, America First.
Yes.
Making in the US has been a big sort of theme. We got this 25% auto tariffs on cars not made in the US, right? I mean, that's just one example. What about capital itself? Will capital allocation strategies change because of what is happening? US versus the rest of the world. I mean, actually, in many ways, US has been the only game in town for the last few years. Will that continue to be the game in town, or you think, how are you thinking about the whole thing?
Sure. Well, it is an attractive market. If you look around the world and you look at the risk-adjusted return, America has a lot of positive things going for it. That probably means we'll try to continue to see other ways of having exposure to the US. And probably if we're not able to do that, maybe because of sort of more of an American first mentality, we'll then have to really try and work out other destinations for some of our capital. I think you also think about two other things which are very important to us. So one is, it's not the new deployment of capital, it's what you already own down there, which actually, how do you make the most of those businesses in terms of maximizing their value? And secondly, we're very, very keen ourselves as an organization to invest in companies, not only to get a return for our members, but to get do it the right way, so we improve those businesses as we own them. So to be a good custodian of the asset, making sure it's a better business when we sell it. Now, if that's not possible because we have a different outlook to some of the American states, then that might be problematic for us.
And are we going in that direction, to your mind?
It depends what we're investing in. So I would guess if we would say we're investing in something around healthcare, that might be a little bit more controversial than trying to help on electricity, power, and transmission, which I don't think is that controversial, but there is clearly a need in the US for more power to serve the growth in demand from data centers and other activities.
What about regions like Asia, India in particular, China, for example? I mean, with this America First stance, what does a money manager do as a global investor? I mean, if you're in one country, if you're an Indian investor, and mostly you can only put your money in India or in the US for that matter, it's different, but you have money everywhere. How does this change things for you, especially with regards to Asia and India?
Sure. Well, we've been investing in Asia for a while. It was a deliberate decision to actually give us that access to higher growth, interesting markets where there's a lot going on in technology and sort of new areas, as well as some of the more traditional fields. We've paused our investing activity in China. We did that a couple of years ago. We actually made that choice because we felt we couldn't necessarily see the growth in that market in the way we had seen hitherto. And also, from our point of view, we trying to compare what we could see as a new investment opportunity there with other parts of the Asian region even. I think it's very dangerous to see India as a substitution for China. It isn't. It's a different business. It's a different market. There are different businesses here. But what we do see here, I think, is a country which is, let's say, disappointed with 6% growth. I mean, I'd be delighted with that in Canada at the moment, to be quite honest. But it also has a very supportive government for inward capital like ours. It has a stable and growing economy. It has the right currency in terms of it being stable to the Canadian dollar, which is one of our other considerations. And we've made co-investments with the Indian government in things like the National Infrastructure Fund, where it's allowed us to navigate what's actually coming up as investment opportunities in the near future. So we've invested in a number of toll roads as well as hospitals and other growing sort of tech businesses in the region, and they seem to be performing very well.
Okay, an interesting chat there that Prashant is having with Joe Taylor. But on that note, we're absolutely out of time on this edition of Business Lunch on CNBC TV 18. Thank you so much for tuning in. Midcap Radar comes up next.